Hi everybody, Steve here. Welcome to your next edition of Highlights. One of the questions I'm asked a lot either through email or at my seminars, whether they're live seminars or web-based seminars, is will support or resistance hold, and other questions related to if a certain level will hold or not. And my response is you just don't know. And with that idea, I have what I call my if-then scenario. Okay, this is on my DVD workshops for those who have it. But, it's always good to review information again, and for those who don't have it, this will be a good educational session. So my if-then scenario, there's a lot of subcomponents. The two I want to focus on in the session today, and this is actually one of my Nison trading principles. I have about 15 Nison trading principles. And the two I want to focus on today, I actually have like 3 or 4 if-then rules. If the market does not act as forecasted, then exit the position, and then initiate a position when the market justifies your potential trade. So if the market does such and such, so if the market breaks above resistance, then you do your action. In this case, then buy. So let's look at the aspect of the if-then scenario. We're actually going to look at the second one, initiate a position when the market justifies your potential trade. But before we do that, because we're going to be looking at a head and shoulders, I want to briefly review what a head and shoulders, and this is, by the way, what we're going to look at first, this if-then rule. So, the head and shoulders, refresh your memory. The market rallies, pulls back, rallies again. The middle rally is higher than the first rally, and rally peak. And then the market descends and then rallies again and stalls. And the middle part is called the head. The head is higher than the two peaks, right, left shoulder, head, right shoulder. And when you connect the lows, when I mean the lows, not just the lows of the real body, but the lows of the session, the bottom of the lower shadows, the lows, you have what's called the neckline. And we call this a head and shoulders in the West, but in the East they actually call it a 3 Buddha pattern. This has been around since the late 1700s based on my Japanese translations. And the reason it's called the 3 Buddha pattern is because there's a middle Buddha and there's 2 smaller Buddhas or saints to the left and right of the main Buddha. So same pattern, different sides of the world, just reflects how the same technical patterns can emerge on opposite sides of the world because people are, people. We all have the same emotions: fear, greed, hope. So anyway, this is a head and shoulders top. So let's look at how we look at the if-then scenario. So here we have, and by the way, we're going to be focusing on Forex in this particular highlights edition, but what I'm saying here is true in all markets, in all time frames. So we have a head, a left shoulder, a head, and a right shoulder. Now this is the neckline. This is the dashed neckline. And I personally, if the neckline is so close to a recent low or pivot low, I would actually use this as my support area. But either way, even if you say the market broke marginally under the support here with this red candle, instead of black it's red in this charting package, and instead of white it's green for the real bodies. Even if you say the market broke under this neckline here, it's certainly not a decisive break, and especially if you're using the support area, although the market moved under it, it didn't close under it. So it really did not or marginally broke under the neckline over here. So this to me would not be a break of the neckline. So what that means, the if-then scenario, if the market breaks the neckline, and this to me is not a decisive break, then we would act accordingly. So if the market closed decisively under the support area here, which in my opinion did not, okay, then we would be thinking about selling short. By the way, one of the great advantages of trading Forex is it's just as easy to sell short as it is to go long. Anyway, so here, this to me is not really a confirmed head and shoulders. So this is a potential head and shoulders over here. It's not a confirmed head and shoulders until the market decisively closes under the neckline. So the if-then scenario, if the market decisively closes under the neckline, then we could think about selling short. If not, you would not be selling short. And by not selling short, look how much money you would have saved. Okay, if this was a standard lot, you're looking at saving on this chart $4,000. So the if-then scenario, if the market does such and such, then we act accordingly. In this case, the market did not break decisively under the support area, so it is not a confirmed head and shoulders. All right. Now let's look at the next aspect of the if-then scenario. This has to do with stops. If the market does not act as forecasted, then get out of the position. Okay, whenever you do a trade, there should be a rationale for doing the trade. For those who have my new DVDs, the Reignited DVDs, you know we have a whole section on using a trading journal. And one of the rules with the trading journal is you write down why you're doing the trade. Okay, if the trade outlook is not going as anticipated, then exit the trade. So let's look at this. So here again in the Euro, US, same market as we were looking at before, just another different time. Last time we were looking a few months ago. This is through this August. So this is a head and shoulders top. Notice how the doji told us the prior rally was running out of steam. All right. So the doji became resistance based on a close for a while. Market pulled back, rallied. Another doji. And this gives us the power, the beauty of the candles. Look at this. The bulls are in charge. The bulls are in charge. And in this one session, the whole tone of the market had changed. So market pulled back. So we have a left shoulder, a head, a right shoulder. The market did break under the neckline, okay, decisively. So let's look at the if-then scenario about if the market does, if you do a trade based on an anticipated action, and if the market doesn't do what you anticipate, then you get out. So the market broke under support. Now, based on the head and shoulders neckline, and let me go back here because I did forget to make reference to it. Okay, once the neckline is broken, that neckline should be a resistance area. And by the way, the neckline could be an angled neckline. I just show it as horizontal. Either way, the neckline, once broken, should become resistance. So if you do sell short under a decisive close under the neckline, if the market gets back above the neckline, then you're wrong. Then you should exit the position. So let's just go through. This quickly here. Let's get back to the slide here. So the market did break under the support area decisively, but look what happened the next session. The old support should have been resistance. And if you weren't comfortable saying, okay, it wasn't a decisive close above the resistance area, certainly on the next session that occurred. So if you were short on this trade, then you should have been out. Then you should have been out because the market told you you were wrong. One of the great things about the charts is there's always a price that says you're wrong.